September 2008, a bank older than most countries collapsed in a single weekend. Lehman Brothers. 158 years of history gone. Trillions of dollars in value evaporated from the global economy. Retirement accounts bled out. Jobs vanished by the millions. But here's the lie we were all told. That this was a sudden accident, a freak storm, a black swan event that no one could have seen coming. It wasn't. The crisis really began years earlier, with a sentence so simple it could fit on every billboard in America. Why rent when you can own? That sentence didn't just sell houses, it rewired our entire understanding of risk, erased accountability, and turned the global financial system into a bomb with a ticking timer. Let's rewind. After the dot-com crash and the shock of 9/11s, America was scared. The economy was fragile. The Federal Reserve, our central bank, responded with its primary weapon. It slashed interest rates, pushing them near zero. Suddenly, money became incredibly cheap. Debt felt almost invisible, and so, borrowing exploded. But instead of this cheap money flowing into building new factories or boosting productivity, it flooded into the easiest asset to sell emotionally: homes. Housing wasn't just shelter anymore. It became a symbol of identity, security, and status. And everyone loved it. Politicians loved it because homeownership rates were rising. Banks loved it because the profits were pouring in. And voters loved it because they felt like they were building wealth. Amid this nationwide celebration, nobody asked the one question that truly mattered. Who carries the risk when this all goes wrong? See, banks used to make loans very carefully. If a borrower failed to pay back their mortgage, the bank lost money. It was a simple, effective rule. But that rule quietly died. A new, more dangerous model took its place. Originate, sell, forget. Mortgage brokers on the front lines didn't care if you could actually repay your loan. Why? Because they got paid a commission for every loan they originated, not for whether that loan was successful in the long run. As you can guess, lending standards completely collapsed. No income verification was needed, no job verification, no assets required. They were infamously called ninja loans. No income, no job, or assets. The risk wasn't being reduced, was just being exported, and Wall Street was more than happy to receive it. This is where things get truly criminal. Investment banks took thousands upon thousands of these incredibly risky mortgages and bundled all them together into something called mortgage-backed securities, or MBS. The sales pitch was simple and seductive. Sure, some of these individual loans will fail, but most won't. Diversification makes the whole package safe. That logic was half true, which made it completely dishonest. Because these loans weren't a random, diverse sample. They were systemically, fundamentally bad. Then came the gatekeepers, the credit rating agencies. Moody's, S&P, Fitch. Their job was to assess risk and tell investors how safe these securities were. But here's the fatal flaw. They were paid by the very same banks whose products they were rating. It was a massive conflict of interest. And so, they stamped financial junk with a AAA rating, the highest possible grade, reserved for the safest investments on Earth. This wasn't fraud born from ignorance. It was fraud driven by perverse incentives. But Wall Street wasn't finished. They took these already toxic mortgage securities and rebundled them into something even worse. Collateralized debt obligations, or CDOs. A CDO didn't even own the mortgages directly. It owned slices of other mortgage bonds. It was layers of risk stacked on top of layers of risk. Complexity became a form of camouflage. The truth is, even the executives trading these things didn't fully understand what was inside them. But they didn't care, because the profits were immediate and the losses were deferred to some distant future. That is the central theme of 2008. Short-term gain, long-term disaster, and zero accountability. Some savvy investors started to smell the rot. They realized the housing market was a bubble and wanted to bet against it. So Wall Street, ever the innovator, created another new product just for them: credit default swaps, or CDS. Officially, they were a form of insurance against a bond failing. In reality, they were just side bets. You didn't even need to own the asset to insure it against failure. This created a nightmare scenario where infinite bets could be placed on the exact same potential failure. If the housing market collapsed just once, these insurance policies would have to pay out dozens, even hundreds of times over. A single company, AIG, sold trillions of dollars worth of these swaps. They didn't set aside any capital to cover potential losses. They simply assumed that housing prices could never fall on a national level. That assumption proved to be fatal. By 2006, the music stopped. Housing prices stopped rising. That's all it took to bring the whole system down. Adjustable rate mortgages, which had started with deceptively low teaser rates, began to reset to much higher payments. Homeowners couldn't afford them. Defaults surged. Foreclosures exploded. The dominoes fell, one by one. The mortgage bonds failed. The CDOs imploded. The credit default swaps detonated like a string of nuclear bombs across the financial system. Suddenly, nobody knew who was solvent. Banks, which run on trust, stopped lending to each other. The credit that greases the wheels of the entire global economy froze solid. And then, Lehman Brothers fell. And the illusion died. The collapse spread instantly around the globe. Europe, Asia, emerging markets. Global trade collapsed. Jobs vanished. Here in the US, the numbers were staggering. 8 million jobs lost. 4 million homes foreclosed. $19 trillion in household wealth erased. This wasn't a normal recession. It was a complete systemic failure. And now came the ugliest decision of all. The government faced a brutal, almost impossible choice. Let the banks fail and risk the complete collapse of the global economy, or save the banks and destroy public trust for a generation. They chose salvation without justice. The TARP bailout, $700 billion. The AIG bailout, another $180 billion. And the result? 0 top executives were jailed for their role in the crisis. Bonuses were paid out at the bailed out firms. Meanwhile, Main Street was left to deal with the wreckage. That moment permanently changed America. People learned a lesson they will never, ever forget. When power fails, it gets rescued. When ordinary people fail, they get blamed. The 2008 crisis wasn't caused by stupidity. It was caused by rational people responding to completely broken incentives. And here's the part that nobody wants to admit. Many of those incentives still exist. The asset may be different next time. The product names will change. But the psychology of the crowd, the hunger for short-term profits, and the denial of long-term risk remain the same. Crises don't repeat exactly, but they often rhyme. The next one won't announce itself with a warning. It will arrive wearing a disguise of profit, confidence, and a sense of inevitability. It's just like the last time. Thanks for watching.